Hello, dear listeners, and welcome back to Book Summary 5, the 5-Minute Summary channel. I'm Sammy, your host. Today, we're diving into Common Stocks and Uncommon Profits by Philip Fisher. First published in 1958, this classic is still a cornerstone of intelligent investing. Fisher's ideas have influenced generations of investors, including Warren Buffett, who famously said his investing style is a blend of Ben Graham's principles and Phil Fisher's philosophies. So today, we're going to walk through the core of Fisher's strategy and the timeless ideas that help us choose companies with not just good stock prices, but real, lasting value. Fisher's big idea is this: great investments are not found just by looking at numbers. They're found by understanding the quality of a business, how it grows, how it innovates, and how it maintains its advantage over time. While other investors in his era were focused on balance sheets and book value, Fisher looked ahead to the long-term potential of a company. He believed in buying and holding outstanding businesses with strong fundamentals, and then letting time do the heavy lifting. He introduces what became known as the 15 points to look for in a common stock. But instead of listing them, let's talk about the essence of what he's after. He wants us to find companies that are genuinely innovative, that consistently develop new products or services, and that have the kind of research and development culture that keeps them ahead of competitors. A company resting on its past achievements won't cut it. Fisher is looking for vitality, a kind of creative engine inside the business that signals it will thrive not just today, but for decades. He also emphasizes the importance of a company's sales organization. No matter how good the product is, if the company doesn't know how to bring it to market effectively, it's unlikely to deliver strong returns over time. He looks for efficient operations, strong profit margins, and management that's both capable and honest. Leadership integrity is essential. He's not just looking at numbers, he's evaluating the character and vision of the people steering the ship. Another crucial point in Fisher's philosophy is the idea of scuttlebutt. He encourages investors to do deep, investigative research by talking to customers, suppliers, competitors, even former employees. This boots-on-the-ground method can uncover valuable insights that aren't in the financial statements. Fisher is advocating for real due diligence, turning over every stone to understand how the business actually operates in the real world. Fisher is also a big believer in concentration, not diversification. While conventional wisdom tells investors to spread their money around to reduce risk, Fisher argues that spreading too thin can dilute your returns. Instead, once you've found a truly great company, you should invest meaningfully and hold on for the long term. The key is to have confidence in your research and in the business you've chosen. Another concept he introduces is the idea that the stock market is often irrational in the short term, and that investors should be emotionally prepared for volatility. He cautions against being too reactive to market swings, urging investors to stay calm and stick with their convictions, provided those convictions are built on a solid understanding of the company. He points out that many investors make the mistake of selling too early. True wealth, Fisher explains, comes not from buying low and selling high, but from buying great companies and letting them grow for years or even decades. Fisher also spends time discussing when not to invest. If a company fails in areas like management transparency, innovation, or adaptability, no attractive valuation can make up for those flaws. He wants investors to have high standards and to wait patiently for the right opportunities. And finally, there's his idea of buying right and holding tight. Fisher's approach is the opposite of speculative trading. He's not timing the market or trying to chase trends. He's identifying companies with real staying power and letting the compound effect of time work its magic. The power of this strategy lies in the discipline it requires and the deep understanding it fosters between investor and business. Common Stocks and Uncommon Profits isn't just a book about picking stocks. It's about how to think like a long-term owner of a business. Fisher's ideas demand thoughtfulness, patience, and a genuine curiosity about how companies work. And more than half a century later, these principles still hold up. Thank you for tuning in to Book Summary 5, the 5-Minute Summary channel. If you found this summary insightful, please subscribe, like, and share it with your friends. Until next time, happy reading and happy investing.